Hello and welcome to It Takes Two. I'm your host, Ethan, and with me is the brilliant Naomi. Today, we're diving into a fascinating business story, Starbucks' challenging journey in China.
Thanks, Ethan. And hello, everyone. Yes, we're exploring how Starbucks, once the darling of international expansion, is now facing some serious headwinds in what was supposed to be its most promising market.
It's such an interesting case study, isn't it? I remember when Starbucks executives were practically saying they could build stores in China forever and still have room to grow.
Exactly. From 2017 to 2020, they added about 200 stores in China. That's nearly 3 new Starbucks locations every single day for 3 years.
And then the pandemic hit. But interestingly, despite China's strict zero COVID policies, Starbucks actually bounced back with explosive growth in 2020.
But that's where the good news ends. Since then, sales have stagnated. Between 2024, revenue actually dropped by about $700 million, even though they added another 200 stores during that period.
Wait, so they kept building stores while revenue was declining? That doesn't sound like a winning strategy.
Right? It's like opening more lemonade stands when people are buying less lemonade. But it speaks to how Starbucks used China as a long-term play with massive potential.
Let's talk about what Starbucks actually means to China. They didn't just enter a coffee market, they practically created one. Coffee wasn't widely consumed in China before Starbucks arrived 25 years ago.
That's a great point. Starbucks defined coffee culture in China the same way they shaped modern coffee culture in the U.S. during the 1990s. But they were unchallenged for years until 2017, when Luckin Coffee entered the scene.
Luckin Coffee is fascinating. By the end of 2018, they already had about half the number of stores as Starbucks and a $2 billion valuation. Talk about a rocket ship.
And then they crashed and burned. In 2020, news broke that Luckin had fabricated over $300 million in sales. They shut down hundreds of stores and got delisted from NASDAQ. It seemed like Starbucks had dodged a bullet.
But the Luckin story didn't end there, did it? They somehow managed to pull off one of the most remarkable comebacks in recent business history.
Absolutely. They emerged from bankruptcy in 2022, restructured their finances, and then went on an absolute tear. From 2022 to 2024, Luckin more than doubled their store count, and now has roughly 6,000 more company-operated stores than Starbucks in China.
That's incredible. And they have a completely different model, right? It's very stripped down compared to Starbucks.
Yes, it's what some analysts call a no-bones, pared-down coffee shop that allows them to expand quickly at a much lower cost, and they've become amazingly good at marketing themselves.
I've heard their locations are tiny compared to Starbucks. They can put them basically anywhere: universities, hospitals, office buildings.
And their ordering system is entirely mobile-based. The only way customers can order is through their app. They pioneered that model in China before it became standard everywhere else.
Speaking of apps, the data shows Luckin is winning that battle too. Starbucks had an app traffic spike in 2020, but Luckin has been outperforming them more recently.
Let's talk about pricing, which is where Luckin really stands out. While the sticker price of their drinks is actually similar to Starbucks, Luckin is known for offering steep discounts constantly.
And Starbucks, which historically rarely offers coupons, has been forced to start discounting as well. That's a dangerous game for a premium brand, isn't it?
Definitely. Starbucks has always positioned itself as a premium experience. That worked great in China when they had little competition and consumer confidence was strong. But after the pandemic, everything changed.
The economic factors are really important here. Chinese consumers, especially younger ones who are the primary coffee drinkers, have been under tremendous economic pressure.
Exactly. Youth unemployment has been high, and there was that collapse in the real estate market where many people, including these young consumers' parents, suddenly felt 20-40 poorer than before.
And there's also the nationalist angle, right? As tensions between the and China have increased, that has affected how some Chinese consumers view American brands like Starbucks.
Yes, though it's more subtle than outright anti-American sentiment. It's what some call brand nationalism, where choosing a domestic brand might be seen as more patriotic or culturally appropriate in certain situations.
So you might not take a date to Starbucks to impress them anymore, but rather to a local Chinese coffee shop that has Chinese characteristics, as the article put it.
Exactly. But despite all these challenges, there's still enormous potential for Starbucks in China. Remember, China's population is more than 4 times that of the U.S.
And coffee consumption is still relatively low, right? I was struck by that survey mentioned in the article. 80 of respondents identified as coffee drinkers, but only 18 drink coffee daily.
That's the huge opportunity. China has traditionally been a tea-drinking nation, and the out-of-home coffee concept is still relatively new there. Starbucks also differentiates itself as a sit-down experience, while competitors like Luckin are mainly grab and go.
So what should Starbucks do to turn things around? They hired a chief growth officer in December 2024 specifically to help with China.
Experts suggest they shouldn't try to compete on price. That's not playing to their strengths. Instead, they might look at better localization efforts, maybe partnering with local players as other Western brands like KFC and Burger King have done.
Luckin seems to be doing really well with localized flavors too, constantly experimenting with new offerings that appeal specifically to Chinese taste.
Another interesting angle is their ownership structure. In China, all Starbucks stores are currently company-operated, unlike in the U.S., where they have a mix of company-owned and licensed stores.
That's a big deal because it means more capital investment and risk for Starbucks. Some analysts think they should move to a more asset-light model in China, either through licensing or a joint venture.
Right? And that could reduce earnings volatility and operational risk. Having local owner-operators might also help with that brand nationalism issue we discussed earlier.
Starbucks has said they're exploring strategic partnerships, which sounds like they're at least considering the licensing option, though no concrete plans have been announced yet.
So the big question for investors is, will Starbucks continue to own and operate its China business directly and bet on an eventual recovery? Or will they find a local partner who will build and license the stores, paying Starbucks royalties instead?
It's a fascinating business case study unfolding in real time, and it shows how even the strongest global brands can face unexpected challenges when market conditions change.
Absolutely. And it's a reminder that past success doesn't guarantee future results, especially in a market as dynamic and complex as China.
Well, that brings us to the end of today's episode of It Takes Two. Thanks for joining us for this deep dive into Starbucks challenges in China.
And remember, if you enjoyed our show, please like, subscribe, and leave us a review. Until next time, I'm Naomi.
And I'm Ethan. Keep thinking critically about business, and we'll see you in the next episode.